Hello everyone, it's me, the Boss Hog. We're back with another portfolio update as of the 9th of December. A little bit of a change this week as we move toward focusing on companies that I'm more familiar with, but the standard stuff in terms of my portfolio update, what's going on, and so on. Let's do it. All right, so in terms of the high level summary, you can see it down 4 grand week on week. Honestly, just generally not a good week. Most of my positions are actually red, and several of them are quite materially red. The dollar didn't help, although it was much less significant than it's been for the last few weeks. And generally speaking, just it was a very unfavourable market. My UK positions didn't do as well as the broader UK market, and although I still continue to outperform the S&P, I'm actually falling further behind the FTSE 350 just because it's such a defensive index. I think I'm still right in saying that the FTSE 100 is the only major index that's up this year to date, just by a couple of percent, but pretty amazing, really. So I'm not overly concerned about the underperformance against the FTSE 350. Again, it's dominated by the 100, and to me, it's just a result of my holdings and my portfolio breakup. So all good. No new capital added. We are now almost through our fair few weeks of cash requirements for various things. I do have a little bit of money put aside, but I basically committed to my wife that I wasn't going to be running our current account as close to the wire as I have been running. We actually had a failed payment, which kind of showed that I'd been running it just on fumes basically for too long. So I think I'm going to keep 1 to 2 grand in there just to make sure that doesn't happen again. So I made that commitment to my missus. So even though there's about 1.9k in there at the moment, I'm going to wait until we get paid. I get paid on the 20th this month. My wife gets paid on the 23rd, and it's her bonus month, which is awesome. So that will take care of that basically from a cash flow perspective. So I expect to be adding more shares around Christmas. Just the one dividend this week, and it's a pretty small one. It's for Microsoft, so I'm more than happy to reinvest in Microsoft. I'm about flat on my position at the moment, so I've got an okay buy price. Not a huge position in my portfolio, just about 1% in Microsoft, but I'm still very bullish on Microsoft long term. In terms of last week, I did reinvest my dividends into Games Workshop and the Clean Energy ETF. For anyone who watched last week's video, I got my dividend for both of those very late on Friday evening and just didn't have time to reinvest them. It's not automated because sometimes I like to put it into other places. So I didn't automatically reinvest it. Microsoft, I actually got paid on Wednesday, but because I was busy with work, I just didn't even look at my portfolio until like Saturday. So I haven't technically reinvested Microsoft's money yet, but it will be reinvested on Monday as soon as the market's open. So that's the position there. An update on this graph. I'm not sure if I've ever shared this graph, honestly, but and again, it's one of the many graphs I have in my portfolio tracker. So I thought I may as well share this one. It is a smidge under 5k, but I wasn't quite sure which other graph to share this week, so I thought I'd go with this one. So yeah, this is basically my entire dividend history. I started investing in very late November 2020 and then really got going in December 2020. So my first dividend started to trickle in toward the end of January. And then it's basically, as you can see, I think I have shared this graph once before actually, because I commented on what happened during late 2021 when I made my portfolio more risky. Effectively, I moved from having a very dividend focused, I was like 4% dividend into like more like a 2% dividend, and likewise as well moved from dollar weighting to basically split. And the difference with that is that US shares tend to pay quarterly, so much more regular. UK shares tend to pay twice a year, and they're not always the same amount either. In fact, often they're not the same amount. It's an interim and full. So you can kind of track it, and it's sort of, you can see the trend there. But basically, as a result of that movement, when then my UK shares started paying out, in sort of April, May, there was a big jump. And to be fair, I expect that to happen again. Like I have a very large position in like Phoenix Group as an example, a UK insurer. And when those come through, there'll be a little spike, and then there was a smaller spike as well. You can kind of see it there in sort of August, September, and again, that's basically the kind of second part, which is the smaller part of my UK holdings. So, but for me, it's really great to see that, especially because again, I'm back to being negative overall in my portfolio this week. So kind of seeing that income from dividends just makes me feel better. So I think it's actually one of those things that I've noticed, that actually having dividend income, it kind of cheers you up because it's a chance to average down. So even though you're feeling a little bit beaten up and there's lots of red on your screen, you kind of feel like you're getting a deal quite often, as long as you still have confidence in the companies, and they're just being pulled down because of general wider stock market or economics. Then it actually feels really good, at least to me, to be averaging down. This is now week 4 of just making sure that my Google document, which pulls together my free portfolios, aligns with trading 212, so we're running at minus £200. So technically let me get this the right way around, my Google tracker is actually lower than my trading 212, so that's fine. But for me, it's important that I make sure that those things align. I have made mistakes before where it didn't align for various reasons. But it's also important to me that, like most of these tables are from Google rather than trading 212. So if ever, like maybe I do it once a year, I just open up trading 212 and walk through it so you guys can see I'm not full of it. But it's just important that those two things match. The reasons why they don't is basically FX and sort of buy sell spreads, and occasionally Google can be a little bit slow to update on pricing. So that's why. Really, for me, as long as this is under about 0.5%, it's a non-issue for me, and it's just something I'll keep an eye on in the long term. I expect this to kind of even out, or stay very close to zero. In the scheme of things. So that's how we're currently doing. Like I say, not a great week. Actually, I didn't really have too much time to feel bad about it this week, just because it's the first week of the month and I was very busy at work. But yeah, I suspect many people suffered this week, and I was just an extension of that. So what more can you do ultimately? All right, so in terms of portfolio updates, I'm still just going to breeze through this very quickly. The green highlights here, these are the companies that, as I touched on last week, I want to sort of specialize in. I feel like I can be a spokesman for them. I'd like to be more familiar, and I don't think they're very well covered elsewhere, even though most of them are quite good opportunities in my opinion. That's why I own them. But I also realized I wanted to become more familiar with them. So again, after this, there'll be actually a breakdown just looking at what was happening with these companies this week. So stick with me for a couple of minutes and we'll get to that. I just want to say also though that last week there was an error in my report. Sorry about that. It was specifically where I'd moved an equation over from the week ending the 25th to the 2nd. Basically, it was still pointing at the same location, so the two columns were aligned. This week, I fixed it basically. So the error was with the 2nd of December. That's now updated to be factual. And then I've included, obviously, an updated week this time as well. And I also just put in place like a very small control in my document to stop that from happening again. So sorry about that, everyone. Surprised actually no one picked me up on it, because yeah, it's quite obvious in last week's video. And I know a few people who subscribe to my channel and watch it are quite detail orientated. So shame on you for not picking that up, but also very much more seriously, shame on me for not picking it up as well. So, but all corrected now, it should be fine. In terms before going into the detail of the green highlights here, I just did want to mention legal in general. One of my subscribers did actually ask me to talk about legal in general because he thought that it wasn't actually well covered elsewhere. So I will kind of be often talking about legal in general. It's similar in some ways to Phoenix, which is more of a specialist, but again, FTSE 100 company. And so as a result, both legal in general and Phoenix had some love this week, as the UK looks like it's going to be moving forward with relaxing capital requirements for financial companies. This is one of the benefits of Brexit, without getting political, but it basically allows the UK to move away from EU standards in terms of capital buffers and so on. What this should mean is ultimately that these insurance companies can reinvest more money and return better capital, or return the same percentage, but presumably on a bigger number as they release capital. So that should be good. By the way, it's being called Edinburgh reforms because, like in the past, the City of London really benefited from what became known as Big Bang, which was like regulatory change. And they were originally calling it Big Bang 2.0, but apparently it was like making people a bit nervous because, the UK's been through a few things over the last couple of months regarding sort of its fiscal position and its budgetary statements. And it was just seen as a little bit too revolutionary, and it would actually be better to call it Edinburgh reforms, which was where the Chancellor, I think it was, or yeah, the Chancellor was doing a presentation on the topics up in Edinburgh. So just to explain the Edinburgh reforms there, what that means. House builders also received some support, and it's interesting as well because not only are house builders, a lot of people have a lot of different opinions about them at the moment, but for the first time in really months, as far as I can see, people have started to make distinctions between the specific house builders. So like as an example, Persimmon is really badly beaten up at the moment, and I think it's a much worse holding than Redrow, which is my main play. Likewise, I think things like Vistry I actually really like as well. And there's a few others, right? It's like 15 companies, and I think most of them represent good value. Even if you think that house builders are going to come under pressure, at the moment they're trading on such cheap multiples. It's like 4 to 5 for profitable companies with good cash reserves and 5 years worth of building timeline. Like they're not, most of them aren't in any real danger. Persimmon was impacted because of its sort of cash position, which is less high. And the fact that people were concerned that they wouldn't be able to support what is quite a hefty dividend. Again, a lot of these house builders do have really big dividend yields, partly as a result of their falling share price, right? It's changed the equation from that perspective. But again, I think there are starting to emerge some differences. So, if you're like exposed to London and the southeast, or if you're exposed to flats that have to pay for cladding to be fixed, right? A kind of big issue here in the UK. Likewise, if you're selling entry-level homes, right, or homes to distressed buyers, you're going to suffer more than people who have big cash reserves and aren't entirely focused in cities and are selling to very affluent people, which again for me is kind of part of the thesis for Redrow. But I still think overall the house builders received some support this week, and Redrow was among them, but it was quite modest. It was still difficult uphill, and you can see here most of this stuff is red. I would say that things like Amcor, it continues to sort of have a pullback from its recent run up, but I still back semiconductors more generally. You'll also see Micron down there as well, and ASML was flat on the week. So but yeah, so that's how it's looking. Like I say, that the column there in terms of the plus or minus will more or less equal the movement in my portfolio. Oh, in fact, it will equal exactly the Google movement within that. So yeah, if you were to be really sad and add that up, you'll get the figure that I showed previously. Without further ado, though, let's have a look at a new format where we just have a little bit more detail about the companies highlighted green here. All right, so I might think about the presentation a little bit, but again, broadly speaking, every week I'm going to go just gloss through these. In some cases, as you'll see here, there'll be no news. And in some cases, especially when we look at earnings or things like that, there'll be a deeper dive into one specific company. But in terms of this overview, we're going to be doing this weekly. So I've just put this in alphabetical order of the companies that I want to be covering. So in terms of Amcor, one of the directors did sell a fairly large chunk of his position, got out at $26. He still does have six figures in there, but definitely sold down quite a lot. Obviously, you can sell for multiple reasons, right? Like buying is more important than selling, but it's never good to see directors selling positions. There was also what I would class as a mixed Zach article. Zach's, I guess, they kind of highlight the value, but they're sort of looking, I think, a little bit historically in terms of some of the, they like lag the semiconductor industry in terms of their return on investment and things like that. Now, for anyone who's followed me, I talk about Amcor kind of reaching their point of sort of scale. I think they're basically there. And for me, like when I look at their earnings, I think they're going to do really well over the next few years. Zach's did concede a few of those points, but to me didn't give enough weighting. So they were kind of like, they still gave it an A rating, so their highest rating, but it was sort of like, that's in the top 20% of opportunities. Whereas for me, I think it's still a little bit higher. I would say there was another article from Seeking Alpha that was glowing. I think that's a fair term to use. Basically, everything that I've just said thinks it's really cheap and basically is very well exposed, will outperform the wider semiconductor industry. It's a really defensive stock. Lots to like about it, basically. So there was a really good essay article on that I definitely recommend. It sort of was reassuring for me as my largest position. But yeah, I think that was a nice read. In terms of Evraz, so a few people do ask me about Evraz. I'm down still in terms of paper loss very significantly. So there's a couple of bits of news just to touch on. So the first one here is quite complicated, so I'll try and do my best to explain it. But ultimately, like many companies, Evraz has bonds that, basically repayments that come due at certain periods of time. They have a $700 million 5 and a bit % note, which is due in 2024, and they were basically seeking a meeting to do something called consent solicitation, which is when you change the terms or any other part of the notes, the bonds. And basically it was cancelled because nobody bothered to turn up, or insufficient people bothered to turn up to actually make it a quorum. The reason that they wanted to basically reconsider their bonds is from their perspective, like Russia isn't allowing them to make a foreign payment in dollars. So they're just not allowed to basically have money leave the country, right? Russia is under sanctions at the moment. And one of the ways that they're trying to manage that is to stop the outflows of foreign currency. So like when you read the Evraz article, they talk about the fact that they would like, additional flexibility during this difficult and unpredictable time, and they remain committed to paying it. They have no financial problem, etc., etc. But I do think if you're a bondholder, you probably aren't going to get paid unless the situation changes in the next 12 months, of course, which it may well do. I did reread the Evraz H1 results, which are a few months out of date now, but should still give us a reasonable picture. And, you know, from my perspective, this is still a profitable company, which I kind of think is surprising and amazing considering H1 at the moment. However, like Evraz itself, not only are several of its largest holders under personal sanctions, most notably Roman Abramovich, but also the company itself is under sanctions. Now, Evraz have contested this. They point out that the main reason why they're under sanctions is because of a misbelief that they're supplying steel to be used in Russian tanks, and they basically said that's just false. We don't supply that factory that makes tanks. We supply one next door that makes railway lines, right? So yeah, okay. So it's that's their argument. Now, for me, I don't really have a concern with Evraz from an economic perspective, although it would be concerning to me if their American steel mills or a couple of European mines were either seized or you know, forcibly purchased. That would definitely suck, especially for the American steelworks, which they spent several years basically making profitable, and literally last year became profitable. And you know, I was really looking forward to getting that upscaled and you know, starting to make some more material contribution. That would really suck from my perspective. So we'll see, but obviously with Evraz, like in the past, I maybe didn't give enough consideration to the political situation, and I think there is always that risk that Evraz itself will be permanently delisted, potentially not allowed back on the FTSE 100 where it previously was. We shall see. And actually, that kind of leads me back on then to point 2 here, which is that Evraz now maintains its own shareholder registry. That is currently being overseen by basically your brokerages and whoever they back it off to. So I guess for Trading 212, like myself, it would be Interactive Brokers. Evraz did say that you don't need to do this, but you could if you wanted to basically write to that company that's holding your interest and basically get your name within that. The main reason that you'd want to do that is because if they were forced to dissolve for any reason, then the admin might be a bit quicker and a bit easier. And likewise as well, if you wanted to request a shareholder paper copy of your certificate, then you could do it through that. There is instructions, etc. on Evraz's website, and I quite like what they've done actually. Like underneath the Evraz logo in the investor relations area, there's like an urgent sign, and if you click on that, there's a couple of documents that are useful for shareholders. So that's nice. Definitely in terms of the bondholder change, that isn't so easy to get my head around. Hopefully I've done it justice. By the way, in terms of what happens next, if they aren't able to reach a quorum, basically Evraz say we'll consult our articles and we'll basically let you know if we decide to do another one. I suspect that they'll probably want to do another one just to show that they're still a serious business interested in governance and everything else. But ultimately here, like until Russia changes its position, it's just not going to be able to pay in dollars, even if it could and wanted to. So that's the current situation with Evraz from my perspective. And like I say, their half-year results were mixed. But most importantly to me, they had an underlying profit, although it was in the like single figure millions, so 6 million. But overall, I think you know, capital investments still held up really well. And you know, from my perspective, it looks like they are continuing to go down that path. So we'll see how that shakes out. Now, Fever-Tree, there is no news here, but actually for me, I think Fever-Tree might represent a value entry opportunity, which sounds a bit mental because I have been a little bit disillusioned by Fever-Tree, but ultimately like Fever-Tree had difficulty overcoming its glass cost and its freight cost and basically achieving scale, and I think a lot of that now is starting to kind of work through the pipeline. So I still like the branding, I still like the product, everything else. So I think like if you are bullish on that aspect and you know you take the argument that that was what was causing them problems before and now that's largely worked through, might be an opportunity to enter. It's still not a cheap value stock by traditional measures, but I just wanted to put that out there because for me, like I think some of the analyst targets at the moment are a little bit ridiculous, either because they're lower than what the share price currently is in some cases, but I do think this is a company that's sort of worth between about 1200 and 1500p. It's definitely gone down for me. Like previously I was talking about it being like 2400, right? Again, when it was like humming and everything was going really well and we didn't have these cost problems. So I still think like that my perception of it has radically changed over the last sort of 2 years. But I would say that where the share price at the moment could still represent a good opportunity to enter, again, if you subscribe to that thought. Games Workshop have recommitted their revenue and profit guidance. It's broadly flat year on year without going into the details here, but what I will say is their core earnings are likely to be down, although revenue will be up. and licensing will be up, which is no surprise. Next year especially should be really good on their licensing stuff with various games coming out, and likewise even H2 this year. You've got like a few games, but notably next year is Space Marine, which looks awesome, and as far as I can tell, the whole community is extremely excited about, and I think they've done a really great job with it. So we'll see how that shakes out as well. I would also say that part of the challenge with Games Workshop, like Games Workshop for me is about a year further along than Fever Tree is. It also had issues with freight, with logistics. Even its like online ordering system was a bit messed up. I think they took too long to invest in it, frankly. But they, again, are getting on top of that stuff and have kind of indexed and over-invested, in my opinion, for many years to come. So again, from that perspective, I'm quite excited over the next few years. And yeah, we'll see. Gamma was less, well, actually, no, there was something. So Simply Wall Street highlighted a 24% return on investment over the last year, and likewise highlighted the last 10 years as being like amazing. I've done 2 videos, I think, on Gamma and highlighted their amazing return on capital. I think they are a real outlier in the telecoms world, and my personal pick for a telecom company to own. I think at the moment it's an absolute screaming buy that potentially has the potential to double and build from there. It's also a very good dividend growth stock for anyone who's into that way of thinking. They've committed to a long-term 11 to 15% year-on-year increase in dividend. So even though the dividend payout at the moment is not a huge amount, I expect that to be a good long-term opportunity. On less good news, Citigroup did do a downgrade to 1350 from, I think, 1620. Now I have a target immediately on Gamma of 1920 is my target, so I would say I disagree quite strongly with Citi. I wasn't able to find the details for why they took that viewpoint. I did find 1 or 2 other older analyst articles where they were talking about sort of challenges and scaling. You know, they've got their European expansion, things like that. But for me, I maintain the viewpoint that Gamma is extraordinarily well placed in a number of ways, and has basically built an incredibly scalable solution that will scale for years. So I remain very confident about that. No news on Gamma on Genius. Hollywood Bowl, not a ton of updates. Berenberg here are actually more optimistic than me by about 10%, about 8% really. So they have a target of 350. Again, just think it's like best in sector, that they bought quite wisely in terms of their first international expansion, and that they will benefit from families seeking low-cost opportunities for family entertainment. So, which is kind of what my position on bowling in general, but they called it out specifically for Hollywood Bowl. Huntington, I would like to do a dedicated video for this, but I kind of want to be realistic with my time at the moment. So here, though, I just want to mention that I thought their last results were really good. There was some concern in terms of their distressed customers and their customers going into debt. A regional bank, you know, you need to be slightly sensitive about the regions it operates in and be mindful about that. For me, however, like previously to that quarter, their debt and distressed customers were running so far ahead that basically this detrimental situation really just takes them back to their year average. So I wasn't overly concerned, but I wanted to highlight that. In terms of everything else, it basically looks amazing. Their synergies are really starting to emerge. I think they've bought really smartly and continue to buy really smartly. A couple of transformational deals, and then a lot actually, or several bolt-on deals as well, just to kind of beef up their you know, business acquisition and kind of middle office things like you know, shareholding placements and yeah, M&A advisory. That kind of stuff makes a lot of sense to me as well. So all of their deposits under management and, you know, their fees are all going in the right direction to me, and it looks really positive from that perspective. Oh, and obviously interest related income is doing really well, but I'd be concerned if it was anything other than that when interest rates are going up. So I guess I really didn't mention that, but just in case there was any questions there as well. Next up, Huntsman. So again, I covered these last week in quite a lot of detail. I remain quite bullish on them. I have a $36 target, I think is quite reasonable, although actually I have a much higher upper end of that as well. But I think like my mid-range here is like, it's not even mid-range, my most realistic number is $36. I sort of remain committed to that. Credit Suisse did upgrade theirs from 30 to 33, so slightly not as optimistic as me, I guess, on Huntsman, but I still like it. My only industrial play, but I like the general where it's exposed to, basically. Kainos is no news, but I have spoken about them very fondly before, and I'm up very large on this company. Oh, very large, about 50% on this company at the moment on a mid-sized position, so that feels really good. Medical Properties Trust, again, I've spoken about these quite a lot, but I will accept I'm about 6 months. I didn't review their last quarter as closely as I have done in the past, but I will make sure on the next quarterly update I'm there a lot closer. There was a analyst upgrade. I mean, actually, how do I call it? It was an analyst comment from Mizuho here. So they still maintain a buy on this stock, but they reduced their target from 20 to 18. Now, my target is like 20 to 21, so I was kind of a bit surprised by that, but they accepted that they've been very conservative with their expectations for 2023, and basically just took the opportunity to nudge their numbers down slightly, but they still think it's a good value opportunity. There's also an article by Real Money arguing that basically this stock represents a great entry and you're realistically looking at an 18% year-on-year return for 5 years. And I think they said it was 80% overall, which kind of looks about right. And likewise, Motley Fool as well had a truly a no-brainer stock to buy. Basically, a very similar thing, right? Pointed out that their earnings put this on like a 6 multiple, that it's trading at like a 0.7 price to book. And that although there are some concerns about some of their customers, actually it was completely overdone, which is kind of a similar position that I'm in as well. Obviously, the main focus with that is Stewart specifically, who still represents slightly more than a quarter of their earnings. But you know, like I think a lot of the bearish positions with medical property is overdone, that being the main one. And then the other one is the fact that they do have a fairly sizable number of investments in their tenants and various other commercial agreements with them. But again, I don't mind that from a niche player. It's not like dealing with realty here where they're, you know, dealing with retail companies. This is a hospital dealing with hospitals, and it's just like it's okay to have a dedicated REIT doing this stuff, in my opinion. They're not alone in the REIT space from that perspective, and likewise, the more specialized the REIT is, the more they tend to have those commercial relationships with their tenants as well. Phoenix Group here, technically they were doing a capital markets update, the CEO and the CFO, so their results are due to be published in March. However, they did release some numbers to support these updates. There was a few good things here. So first of all, I would say really great results. They nudged up their medium-term expectations by about 10%. By medium, I'm talking like 23 to 25, as in 2023 to 2025. This is a long-term pension company. They manage sort of a lot of closed life assurance books, as well as moving into sort of wealth management. So they're starting to get a little sexier, but this is still a kind of business that does take a little while to show big moves, if ever, right? That is pretty big for this kind of business. I would also point out, especially for UK viewers who are aware that the budget shock that went through with our previous Prime Minister impacted insurers quite heavily. Legal & General, for example, were impacted by that, although they kind of had the capital positions to ride out without issue. However, Phoenix were even better. So they have almost no exposure to LDIs anyway, which was the main issue here. And they basically said that we have so much money available for acquisitions that any margins that we, you know, that were going to be impacted, we had no problem covering. And basically, we have no material impact from that whole episode. Didn't concern us at all. And, you know, yeah, there was that modest kind of, you know, any knock-on effects, but they didn't really feel like they were particularly exposed. I would say that if you want a business in the financial sector that hedges the life out of itself, you should look at Phoenix. Their hedging policies on just about everything is pretty extreme, like everything from electricity to foreign exchanges to you know, repackaging their insurance products is all heavily hedged from that perspective. So again, another reason why this company takes a little while to kind of move positively or negatively. So for me, I still think there's like 20% upside in Phoenix. It has completely recovered from the big fall that all of the insurance companies had as a result of that budget. But yeah, I think they were good results. It also committed, as far as I can tell, the first time to a return on capital employed in the mid-teens, which would put it in line with Legal & General. Actually slightly better, I would say, if I take the mid-teens to be like 15, 16%. So that was really good to hear that, actually. Like, again, this is a company that's going through a bit of a transition. And so to be starting to commit to kind of things like winning new businesses, to this kind of improvement in capital employed would be a real significant improvement. And actually, like, all the sexy stuff with Phoenix is about the future, specifically its wealth management. And this is really driven by its quite transformational purchase of Standard Life. A lot of people won't realize that Phoenix owns Standard Life, which is a big company in the UK. And they were pointing out that over the last year, they've won 68 workplaces covering 48,000 people and $2 billion in assets. Now, to put that into context, that's 10 times larger than the number that they were winning before Standard Life. So extremely impressive as they scale up. Again, this market cap of this company is only like 6 billion. It's not a particularly big company. It's sort of relatively low down the FTSE 100, although it is building. So for me, I was really happy with Phoenix. I still think it's undervalued. I know a few people in Discord were thinking that, oh man, I wish I bought a bit more when it was like suffering from that budgetary update. But to me, Phoenix still doesn't look expensive. You're still looking at like an 8% yield, which is super well covered. And you get the excitement here that if any other insurance companies are distressed, Phoenix just has so much money on hand. And again, it's got like 1.5 billion, right? This is a $6 billion company. Like the last, before Phoenix started buying a few more companies this year, there was a little bit of disquiet from analysts on earnings calls about whether there was like any possibility of a special dividend or a buyback or etc. But Phoenix are very clear that they basically want to keep the war chest, and they do expect to be spending over the next few years, and we will see what that looks like. But for me, that's quite exciting, and I enjoyed the Phoenix update quite a lot. No news on Polymetal. I do, broadly speaking, update Polymetal and Everaz together. However, Polymetal is still trading, although it's heavily exposed to Russia. Even though it's got a very large exposure to gold and silver, which you would think would be doing potentially quite well at the moment, its share price is absolutely battered for similar reasons. It just doesn't have the personal or business sanctions that Everaz does. So, but broadly speaking, I group them together, and I'm down very materially on them. Combined, by the way, I'm down about 8 grand on paper, 8 grand on Everaz and Polymetal. And at this point, they represent about 1.2% of my portfolio between them. And I'm basically just either riding it to zero or hoping it will recover one day. But for me, it's interesting to keep an update on both of those as well. And in terms of the last one, I am working on a Vodafone deep dive, in which I will broadly be arguing that I think Vodafone is a bit of a value trap. It's not quite ready yet, and to be honest with you, in some way reading, I can see some light at the end of the tunnel, or maybe some ways that you could maybe take a slightly less bearish position to that as a summary headline. And I just kind of wanted to get a bit more familiar with those aspects. So, but I've been a kind of casual observer of Vodafone for quite a while, working in the telco industry. I thought their recent results were really poor, actually. It's interesting that their CEO basically got fired. I mean, it's like, he left by mutual agree, but he got fired. And, they put in an interim CEO who was their previous CFO, and I'm not really impressed with that appointment at all. I think that's the wrong person to be needing to improve Vodafone if you were to take some of the more bullish points where they might be seeing growth. So I'm hoping that Vodafone will currently be in the market for a new CEO who could be transformational. But yeah, I'll save that for next week and basically do a dedicated chunk on Vodafone. Anyway, that's all I have for now. 30 minutes is probably long enough. Thank you very much for watching, everyone who got this far. I've been the Boss Hog, and good luck for your investing. Bye for now.